In this video, I'll give you 7 steps on how to improve your options selling strategy so that you will not only increase the premiums that you can collect, but also reduce the risk when you are selling your options. And with that being said, let's jump straight into step number 1, choosing the underlying that you want to sell your options on. For this, it depends on the strategy that you are using. If your strategy is the cash secured put or the covered call, it's best to do it on a stock that you already like. For example, if you like Apple and Amazon, then you do it on Apple and Amazon. That's because the great thing about cash secured put and covered calls is that it lets you buy or sell the stock that you already like at the price that you want while letting you earn money at the same time. And in the case of cash secured put, even if the stock crashes and you end up getting a sign, no worries, because if it's a good stock, you can just wait for the stock to recover. One common question that I get is that, is there any cheap stocks that I can sell options on? The short answer is generally no. Stocks that are cheap, aka penny stocks, tend to be more vulnerable to pump and dumps, have lower liquidity, and possibly even lousier earnings. That's why it's better to go with more established stocks, which unfortunately are also more expensive. So in that case, you can switch over to using credit spreads. So instead of having to prepare money to buy 100 stocks, all you need to do is just prepare enough money to cater for your max loss. For example, if you build 160 bull put spread expiring on the 10th of May, you will only need $430.50 as the collateral. Also, instead of just looking at stocks, you can also add ETFs into your list of options to sell options on. Here's why. 1. There's no earnings dates for ETFs, which means no sudden movements during earnings. For example, if you were to look at Tesla's prior earnings moves, Tesla either goes up by 10% or crashes by 10%. And even when the result beats the estimated EPS, the stock can still crash. So it's super unpredictable. But for ETFs, you won't have such problems. So you get to keep selling options all year round. And 2, Hasty Trade found that ETFs movements tend to have less outlier moves as compared to stocks. So you will have fewer situations where you wake up and see your ETF suddenly go past your strike price. Step 2. Decide when is the best time to sell options. By right, we want to sell options whenever we want, but there's a good time to sell and not a so good time to sell. So here's a checklist to help you decide when is the best time to sell options. Avoid selling them across earnings dates as they can be super unpredictable. 2. The best time to sell your options is when implied volatility is high. This lets you either collect more premium at the same strike price or lets you sell at the further strike price to collect the same amount of premium. For example, here you can see that the higher the implied volatility, the higher the option price. 3. Be aware of when the stock is oversold or overbought because there's an increased chance that the stock might reverse and go against you. One way to do this is by opening up TradingView. Then look for the RSI indicator. If the stock is above the 70 level, it is in the overbought territory and it may reverse down. And if the stock is below the 30 level, it is in the oversold territory and may reverse up. So what you can do is if the stock is in the oversold territory, you can look to sell a call above the stock price. And if the stock is in the overbought territory, you can look to sell a put below the stock price. This can help to increase your probability of success. But this is not to say that just because it's been overbought or oversold, it will definitely reverse. The stock can remain overbought or oversold for a very long time. So rather than just rely on one indicator, what you can do is look at the trend to further improve your probability of success. But if you are a noob at technical analysis like me, don't worry, because here are 2 simple tools to help you out. 1. In TradingView, look for the breakout probability indicator. This indicator will tell you the probabilities of where the stock might go next. 2. In some apps like Webull, if you head to the analysis tab, scroll down to technical analysis, it will tell you what are the signals that it has spotted in the short, medium and long term. Similarly, IBKR also has something similar. You can click on Research, Discover, Technical Insight, look for the stock that you want to analyze, and you will find a quick chart analysis which will tell you where the stock might possibly go in the short, intermediate and long term. With this, you could use it to determine where the stock might potentially go next. Quick pause. If you're looking to trade options, you can check out Webull. At just 55 cents per contract, Webull actually beats many of the other brokers which charge a higher fee on US options. With Webull's easy-to-use options platform, you will find useful options data such as the implied volatility, the Greeks, break-even price and so on. There's also an advanced charting tool where you'll be able to add popular charting indicators such as moving averages, Bollinger Bands and relative strength index, which you may find helpful when analyzing the price movements. Besides that, Webull also provides you with some useful features such as option statistics and probability analysis tools to help you better analyze your probability of success even before making a trade. Right now, Webull is running a few promotions. For the welcome promo, if you make an initial deposit of $500 or more into your account and complete one US buy trade, you will first get 5 free Nvidia shares worth $10 to $500 each. And for my viewers who use my exclusive link to sign up, you will also get 2 additional Nvidia shares worth $10 to $500 each. Next, you can also get up to $2,950 worth of Nvidia shares by depositing $100,000, complete 10 US buy trades, and fulfill the maintain requirements. Alternatively, you can get the rewards by subscribing at least $100,000 to Moneybull and maintain the funds till the end of July 2024. Lastly, there's a new transfer in promo from which you could get up to another $10,000 worth of Nvidia shares for both new and existing users who have not transferred any stocks into Webull prior to this. Particularly for new users who sign up with my link in April after successfully transferring more than $5,000 worth of shares to Webull, you can get 3-month commission-free US stock trading as an exclusive bonus. So if you're interested in trying out Webull, do sign up to them using my link down below. And with that being said, let's get back to the video. Step 3. Decide which is the best days to expiration to sell your options at. Should you sell your options at a very short 1 to 7 DTE where theoretically your options do not have much room to move, or is it better to go with longer DTEs? Tasty Trade recommends using the option that's closest to 45 DTE. Here's why. The closer the options get to expiration, the faster the time value of the option decays. So if you sell an option that's too far out, like 90 DTE, there's not much decay going on and you will have to wait for a long time before you will start to see a decent profit. On the other hand, if you sell your options that's near expiration, most of the time value has already decayed and you will get very little premiums for the risk that you are taking. So Tasty Trade backtested this. What they found was that at below 45 days to expiry, the expected move of the stock is consistently lower than the realized move of the stock. But when you go 45 DTE and above, the expected move was consistently bigger than the realized move. So if you want the odds to be in your favor, or if you want an edge, it's better to go for the 45 days to expiration. Here's another study based on credit spreads. What they found is that the longer the DT is, the higher the win rate. And for core credit spread, while the win rate is about the same, they found that the 45 DTE has the highest average profit loss per day. Now, of course, this is not to say that going below 45 DTE is bad. It's just that statistically, 45 DTE seems to give you the slight edge to improve your probability of success. If you want to go lower than 45 DTE, it's perfectly fine too. Step 4. Choosing your strike price. For this, you always want to balance profitability and probability. So while going for a very low delta, like 0.01 delta gives you a 99% chance of success, you're only earning very little premium for the risk that you are taking. Whereas if you go for maybe a 0.5 delta and earning a lot of premium, there's a very high chance that it could go in the money. So what are some best practices for choosing your strikes? Again, Tasty Trade did a back test on SPY and they found that a delta of between 10 to 30 would give you the highest return on capital per day. That's why the general rule is to sell options with a 30 delta. 30 delta means that you have about 70% probability of success. Or in other words, if you keep selling at 30 delta long enough, you will win about 70% of your trades. But other than this, there's another thing you can do to improve your probability of success, and that is choosing a strike price at slightly beyond the support and resistance levels. Again, don't worry if you are a noob like me. Here's an indicator to help you out. In TradingView, search for the support and resistance levels with breaks indicator, and boom, it will show you all the potential support and resistance levels. Step 5. Spread out your trades. Let's say you have enough collateral to sell 10 contracts. You don't want to just all in into one trade, because if the stock goes against you, you will lose all 10 trades. Instead, what you want to do is spread out your trades. So there are 3 ways to spread out your trades. 1. You can spread it across different expiration dates. So maybe you can sell 3 contracts this week, 3 contracts next week, then another 4 contracts the following week. This lets you follow the stock price as it goes up and down. 2. you can spread it across strikes. So instead of just selling at one support or one resistance level, you can sell it at different strikes. For example, instead of just selling at $160 strike price, you can sell it at $155, $150, and so on. Even if the stock goes against you, you won't lose all your trades. And lastly, you can spread it across stocks. Different stocks will move differently. So you can diversify across stocks to reduce your concentration risk. Step 6. When should you exit your position? There are 3 strategies here. You can either hold it till expiration or close at 50% profits or close at 21 DTE. So which is better? For this, we can look at Tasty Trade again, which has done some back testing on this. What they found was that if you hold till expiration while your win ratio is at 85%, your annualized return on capital would also be the lowest, meaning you aren't using your capital as efficiently as compared to the other 2 methods. Whereas if you close your positions at 50% profits, you will have the highest win ratio and the highest annualized return on capital, which makes sense because you are consistently realizing your profits whenever you can. And in a bull market, you are more likely to be hitting the 50% profits earlier. However, the downside is that in huge market crashes, you will encounter the largest loss. Lastly, for the 21 DTE method, while the win ratio and annualized return on capital is the lowest, you also won't encounter a large loss since you are closing your positions earlier. Here's the same thing, but shown as a graph. During market crashes like in 2008, 2011 and 2020, the 50% winner method will see a huge dip since you are holding it through the crash, whereas closing at 21 DTE would encounter lesser losses. So which strategy should you go for? The answer is to use both at the same time. Once you hit the 50% profit, you can close the position and move on to the next trade. Otherwise, if you hit the 21 DTE and if you see the trade isn't going according to your plan, like maybe it's moving against you, you can decide to close the position at 21 DTE, then reopen the trade to reset your position. That way, you'll get the best of both worlds. Pro tip: certain brokers like IBKR lets you attach another order on top of your existing order when you are placing your trade. This lets you automatically close the trade at the 50% profits. Step 7. How do you manage your losses? Let's talk about defined risk strategies like credit spreads or iron condors first. For these strategies, you already have a stop loss, so you don't really have to manage your losses. Tasty Trade back tested this and they found that in terms of returns, holding it till expiration is actually better than closing at 2x losses. The reason for this is because stop loss tends to reduce the probability of profit, and as a result, it can negatively impact the long-term performance of the strategy. So a better way is to close the trades earlier at 21 DTE instead of holding till expiration or doing stop loss. Next, what about covered calls and cash secured puts? For this, there are 2 ways you can do this. 1. If it's a price that you are okay with getting assigned or getting called away, you can just do nothing. But if you suddenly change your mind, then you can roll it as soon as it touches your strike price, which is around the 0.5 delta mark. You roll it out and into further expiration dates. And more importantly, make sure you collect a credit when you roll. Again, Tasty Trade has back-tested this and they found that rolling your trades tend to give you higher profit and loss as compared to not rolling. And more importantly, by rolling your trades, you will end up having more trades that are profitable, even though that adds additional duration to your options. So again, here's a pro tip. While you don't have to keep monitoring your stocks every single day, what you can do is create a price alert to automatically notify you when a stock reaches a certain price so that you can take necessary actions to protect your trades. So that was the 7 steps to improve your options selling strategy. Hopefully, you found this useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.